All right, now you understand some of the tools. All right, now that we've learned some of the tools that the Fed has to influence money supply and thus the economy, we're going to look now at exchange rates and then move on to inflation, which will be the last concept for this topic. All right, so we're just going to do a very brief introduction to exchange rates here, because I just want you to understand what exchange rates are and a little bit of the terminology around the way that we talk about exchange rates. So we talked before about how in the past currencies had been pegged to commodity prices or fixed to commodity prices, but that today the value of many currencies is determined by money supply and money demand. Except for in cases where the country pegs its currency to the value of another currency. That is called a fixed exchange rate, when one currency's exchange rate is fixed to another currency. But like we said before, most countries allow the value of their currency to fluctuate with the market, and we would call that type of an exchange rate system a floating exchange rate. So floating exchange rate is where exchange rates, the rate at which you can change one currency for another, fluctuate freely based on supply and demand for that currency on the foreign exchange markets. All right, so what does a foreign exchange market look like? So sometimes these are called Forex markets, which stands for foreign exchange markets. They're markets where you trade one currency for another. So in this market, we've got euros for dollars. And for any market, we could write it one of two ways, right? We could say, what's the market for dollars in terms of euros? Or we could say, what's the market for euros in terms of dollars? And this leads to a little bit of confusion because we can't say, right, that the exchange rate for euros is increasing or decreasing, because there's really two different ways to write that exchange rate between euros and dollars. Instead, we use language of currency appreciation and depreciation. And so we'll talk a little bit about what that means in a minute, but first let's just understand what's going on in this market. So the way that I've written the market is in terms of dollars. So here we're going to be buying dollars or selling dollars in exchange for euros. Demand for dollars, that would be people who have euros but would like to buy dollars. Okay. And the supply in this market would be people selling dollars, and those people would therefore be buying euros, right? So you can start to see how we could write this market two different ways. But in any case, supply and demand for dollars in this market is going to lead to some equilibrium exchange rate for dollars against the euro, okay? And so really we can think about describing both supply and demand in this case in terms of demand, right? So the demand for dollars is people who would like to buy dollars by selling their euros, but the supply of dollars is people who want to buy euros. So we can really just talk about what drives currency demand, and then we can describe both of those equations. So sources of demand for a currency, okay, are people who want to buy goods produced in that country. So in this case, demand for dollars is going to be driven by people who want to buy goods produced in the United States. Remember that anytime we produce something in the US and then we export it, okay, we're going to be selling that product and we're going to be selling it in dollars. So if somebody wants to buy something produced in the United States, they've got to change their currency for US dollars before they can make that purchase. People who want to invest in US companies, so say somebody wants to buy stock in Apple, somebody who lives in China wants to buy stock in Apple, they first have to change yuan for dollars, and then they'll be able to purchase that stock, right? Because the US stock will be sold in dollars. And then the third factor here is currency traders who speculate on what exchange rates will be in the future, right? So if you say expect exchange rates to, say, the dollar to become more valuable in another month, you might go and buy up dollars now cheaply because you expect dollars to be valuable in the future, at which point you could sell them. The effect of that really is to drive demand for dollars up today, increasing the value of the dollar today based on future expectations about the value of the dollar. So currency traders, right, and this type of trading is going to happen in any kind of market. So really, the value of any asset today reflects all future expectations about the value of that asset in the future. All right, so we've got people who want to buy dollars, we've got people who want to buy euros, and they're trading with each other. And then that results in some exchange rate, some rate of exchange between dollars and euros. And again, we're going to use these terms currency appreciation and depreciation rather than saying exchange rates are increasing or decreasing, to avoid any confusion about the way we write this, if we're writing it as the exchange rate between euros and dollars or dollars and euros. So currency appreciation means that the currency is increasing in value, right? So if the dollar appreciates, then that means that each dollar is going to buy more euros. When a currency appreciates, say appreciation, means that that currency is increasing in value relative to other currencies. So that it would take fewer dollars to buy every euro, or more euros to buy each dollar. All right, good. And then depreciation, currency depreciation would be the opposite. It would mean that it would take more dollars to buy each euro, or fewer euros to buy each dollar, as the dollar becomes less valuable relative to the euro. All right, good. So that's it, really. That's all I really want you to know about exchange rates. We are going to return to talk about exchange rates in the next topic. So just trying to give you a little bit of a background here. The next thing we're going to tackle is inflation, and I want you to watch now a couple marginal revolution videos before we come back to talk about inflation together. So watch this quantity theory of money video, and here you just write down the variables in that equation for quantity theory of money. And then also watch the video causes of inflation, okay? And you'll get a little background on how economists think about the causes of inflation, and then we'll come back together to talk about the costs of inflation and hyperinflation. All right, I'll see you in a few videos.